At 44, Angela finally sees $20,000 in savings. 4 years. That number looked like safety. Now it begins to look like permission. Permission to move into the apartment with the extra room. Permission to replace the car before the next repair. Permission to add the services she kept postponing. Nothing on that list is morally wrong. The danger is that one visible balance can be asked to do 4 different jobs while being displayed as one spendable number. That is the late starter problem this video will solve. Not whether $20,000 is enough for every household. Not whether Angela deserves a better apartment or a reliable car. And not whether saving should become a life sentence of saying no. The problem is a decision system that lets a milestone become permission to raise fixed costs before the dollars have assigned jobs. That mechanism has a name: the Milestone Permission Tax. It is not a government levy. It is not a bill Angela has already paid. And it is not proof that Angela is careless. The Milestone Permission Tax is the option cost created when a visible cash milestone is treated as free spending capacity, even though part of that cash may already belong to emergencies, annual bills, transitions, and future routes. $20,000 is not a magical threshold. It does not automatically raise a credit score. It does not automatically lower loan rate. It does not guarantee lower insurance costs, better prices, or better decisions. The Consumer Financial Protection Bureau says the amount needed in an emergency fund depends on the person's situation. That is the right boundary for this story. $20,000 matters here because it is Angela's actual milestone, not because it is a universal finish line. Angela is a fictional composite. She is a public school instructional coach in Memphis. She is 44, with 23 years to age 67 as a planning marker. Her gross pay is $68,000 per year. Her modeled take-home is $4,300 per month after payroll deductions and her current retirement contribution. Her tracked monthly outflow is $3,950. That includes a scheduled $300 card payment and her required student loan payment. Her current monthly margin is $350. She has $20,000 in cash, $31,000 in retirement savings, $8,400 on a card charging 22.99%. and $14,000 in student loans at 5.5%. She currently contributes $200 per month to retirement. Her narrow-tracked position is $28,600, $20,000 cash, plus $31,000 retirement, minus $8,400 car debt, minus $14,000 student debt. That is not her complete net worth. It excludes her vehicle, pension rights if any, personal property, other accounts, taxes, insurance value, and every unlisted obligation. The number is only a consistent baseline for this case. Now look at the screen Angela sees. Her bank app shows one balance, $20,000. It does not show which dollars protect next month's rent, which dollars cover annual insurance and school year expenses, which dollars keep a job transition from becoming an emergency, and which dollars are genuinely available for a new decision. That is the first mechanism. Balance meaning blur. When dollars with different jobs appear as one total, the total can feel more available than it is. The blocker is a money job map. This is Angela's personal map, not a universal formula. $10,000 is assigned to her emergency reserve. $3,000 is assigned to annual and irregular expenses. $2,000 is assigned to opportunity and transition costs. $5,000 is decision cash. $10,000 plus $3,000 plus $2,000 plus $5,000 equals $20,000. The balance did not shrink. Its meaning became visible. The Consumer Financial Protection Bureau describes emergency savings as cash reserved for unplanned expenses and emphasizes that the amount depends on the person's circumstances. It also recommends keeping those funds safe and accessible. Angela's money job map applies that principle to her own facts. It does not claim that $10,000 is the correct emergency reserve for you. Now the second mechanism can be tested. The fixed cost ratchet. A cash milestone is a stock, rent, car payments, and subscriptions are flows. A one-time stock can absorb a deposit or down payment, while the new monthly flow continues long after the original balance has changed. Angela has not accepted any upgrade. She is only testing a hypothetical menu. The apartment upgrade would add $350 per month. The vehicle upgrade would add $420 per month. New recurring services and subscriptions would add $130 per month. Together, that is $900 per month, or $10,800 per year. Again, this is a decision simulation. It is not spending Angela has already committed. It is not a tax invoice. Her current margin is $350 per month. 350 minus 900 equals negative $550. The $20,000 balance could make the first month look affordable while the recurring system creates a $550 monthly gap. The blocker is a recurring cost gate. Before a milestone funds a recurring commitment, Angela asks 3 questions. What is the full 12-month cost? Can base income carry it without drawing down assigned reserves? And what future route must be delayed to keep it? The gate does not automatically reject every upgrade. It forces the recurring cost to compete honestly with the monthly cash flow it will occupy. For the full $900 menu, the gate says not yet. Not because Angela failed, because her $4,300 take-home and $3,950 tracked outflow leave only $350 of current capacity. If a smaller choice passes the gate later, it can be planned without pretending all $20,000 is unassigned. This distinction matters. Financial control is not the removal of every enjoyable expense. It is the ability to choose an expense without making emergency cash silently subsidize it. Now comes the third mechanism: future route delay. When a milestone has no written routing rule, the most visible present claim can arrive before the highest cost debt and the future contribution. The blocker is a milestone routing rule. Angela writes the order before the next persuasive offer appears. First, preserve the dollars already assigned to essential resilience. Second, test high-interest debt. Third, create a future route for the monthly cash flow that debt releases. Fourth, protect some planned flexibility so the system can survive real life. This follows a capital allocation principle, not a worship of one number. In Berkshire Hathaway's 1999 shareholder letter, Warren Buffett distinguished funds needed in the near term from capital available for optional outlays. That letter does not prescribe a $20,000 household threshold. It does not tell Angela what apartment to rent. The useful idea is structural. Protect near-term needs before treating capital as optional. Investor.gov also advises people receiving a lump sum to consider reducing high-interest debt, strengthening emergency savings, and investing regularly. Angela's route combines those categories without pretending one sequence fits everyone. Here is her modeled action. She keeps $15,000 assigned across emergency, irregular, and opportunity jobs. From the $5,000 of decision cash, she applies $3,000 to the card. She retains $2,000 as decision cash. Cash becomes $17,000. The card balance becomes $5,400. Her narrow-tracked position remains $28,600. $17,000 cash, plus $31,000 retirement, minus $5,400 car debt, minus $14,000 student debt. Moving $3,000 from cash to debt changes the composition, not the position. That is why this is not a fake $3,000 gain on day one. Investor.gov says paying off high-interest debt generally offers less risk than trying to earn an equivalent investment return. That is guidance, not a command to empty every reserve. Angela does not empty hers. She then redirects her $350 monthly margin to the card. Added to the scheduled $300 payment, that creates a modeled payment of $650 per month. The payoff model assumes no new charges, a constant annual percentage rate of 22.99%, monthly compounding, month-end payments, and no added fees. Under those assumptions, the $5,400 balance is paid in month 10. The final payment is approximately $88.46. Total modeled interest is approximately $538.46. Actual card calculations can differ because issuers may use daily balances, different cycle lengths, fees, or changing rates. The exact statement and agreement control. The model's job is not to promise the exact payoff date. Its job is to make Angela's routing decision visible and testable. After the modeled payoff, $650 per month is released. The milestone routing rule assigns it before lifestyle inflation can claim all of it. $500 per month goes to retirement. Added to her existing $200, the total retirement contribution becomes $700 per month. $100 per month rebuilds decision and opportunity cash. $50 per month remains planned flexibility. $500 plus $100 plus $50 equals the released $650. Angela has not banned enjoyment. She has given it a protected line instead of asking emergency savings to cover it invisibly. For context, $700 per month is $8,400 per year. That is below the general 2026 employee deferral limit published by the IRS for 401k and similar workplace plans. But Angela's actual eligibility, plan type, compensation rules, employer contributions, tax treatment, and available investments must be verified in her plan documents. Now we can test the future route without turning a projection into a promise. Angela begins with $31,000 in retirement savings and a $200 monthly contribution. The runway to the age 67 planning marker is 276 months. In the baseline scenario, she contributes $200 per month for all 276 months. At a fixed nominal 5% annual return, the modeled ending value is approximately $200,902. At a fixed nominal 7% annual return, it is approximately $290,802. In the action scenario, she contributes $200 per month for the 10-month card payoff period. Then she contributes $700 per month for the remaining 266 months. At 5%, the modeled ending value is approximately $443,582. At 7%, it is approximately $607,782. The modeled difference is approximately $242,681 at 5%, and approximately $316,980 at 7%. Those differences are not money Angela is currently losing. They are not milestone permission tax invoices. They are nominal fixed return scenarios before fees and taxes. Markets do not deliver fixed returns. Contribution timing, investment choice, inflation, taxes, fees, withdrawals, employment changes, and market sequence can produce materially different results. The figures do not prove retirement adequacy. The age 67 marker comes from the Social Security full retirement age schedule for people born in 1960 or later. It is a planning marker, not an instruction about when Angela must retire or claim benefits. The point is not that $20,000 changes everything. The point is that the meaning assigned to $20,000 can change the next decision. Without blockers, one balance can look like permission for 3 recurring commitments. With a money job map, Angela sees which dollars are already working. With a recurring cost gate, she compares a 12-month obligation with recurring income instead of a one-day balance. With a milestone routing rule, she decides where released cash flow goes before every present claim arrives. Balance meaning blur is blocked by the money job map. The fixed cost ratchet is blocked by the recurring cost gate. Future route delay is blocked by the milestone routing rule. That is the complete architecture. Pressure becomes analysis. Analysis becomes relief. Not because every risk vanished. Because Angela's dollars now have written jobs, her decision gate uses recurring math, and her future route leaves room for both resilience and life. If you are a late starter between 38 and 52, do not ask whether your savings balance has crossed someone else's magic number. Ask 3 narrower questions. Which dollars already have jobs? Which recurring cost can base income carry for 12 months? And where will the next released monthly dollar go? Write the answers before the milestone starts negotiating with you. That is how $20,000 stops being permission and starts becoming a plan.